Federal Reserve is moving in the direction of cutting rates after being on the sidelines for most of 2025. What does this mean for stocks, bonds, and other investment assets? Hello and welcome to the Cedar River Capital Market Touchstones slideshow update. The date today is September 12th, 2025, and today we'll be discussing what we believe to be the main factors driving stock and bond markets today and going forward. My name is Paul Latta. I'll be doing most of the speaking today, but my business partner Baj Kochar and I are both available for questions and discussion. Our contact information is available on our website at cedarrivercapital.com. Our agenda today will have four parts, beginning with a discussion about the recent market action, stocks, bonds, and other assets. Then we'll look at the macroeconomy to add some support behind the market discussion. Then we'll move to a microeconomic view and look at key industry-specific drivers. And then we'll conclude with a longer-term observation about the investment landscape. The S&P 500 is up 13% year-to-date through September 12th, as shown on the left, and we seem to be putting that volatility from March and April behind us now. The chart on the right shows the S&P 500 is up 120.5% over the last 5 years, and that there have been a couple of pullbacks along the way. The bond market is up 6.5% year-to-date, as shown on the left, with most of that gain in just the last month or two on prospects for rate cuts from the Federal Reserve. Over the last 5 years, bonds are down 2.1%, as shown on the right. The bond market is still below its 2020 highs when central banks around the world cut rates to near zero amid the COVID pandemic. The Fed lifted rates high in 2022 and 2023 amid a post-COVID inflation surge. But as inflation has softened, the Fed has been slow to cut rates. As you can see here, the Fed has been in pause mode for the first 8 months of 2025. But rate cuts do seem imminent, as we'll see on the next slide. Fed funds futures are now implying a 96% chance of a 25 basis point rate cut at the September Fed meeting this week, and additional rate cuts at subsequent meetings, as you can see in the blue squares on this table. This is a more dovish outlook than just a month ago, and reflects a combination of modest softening in the labor market, as well as inflation levels that are fairly modest. While it appears the Fed will remain in a dovish stance for most of the rest of the year, the Fed funds futures are dynamic and will respond to changing signs of economic strength or weakness, as well as signs of inflation weakening or strengthening. Most global central banks have been cutting rates since inflation peaked in 2022, but with variations in timing and levels. The U.S. is one of the very few central banks that has not cut rates as of today, September 12th. This mainly reflects the new U.S. tariff policies that have lifted fears of stagflation, thereby putting the Fed on the sidelines when other central banks were cutting rates. The only two central banks of size that are raising rates are Japan and Brazil. Japan, of course, is seeing slightly elevated inflation and formerly had a very dovish negative rate policy. For Brazil, inflation is also resurging, likely due to cutting rates a little bit too fast last year, thereby weakening the currency, and the weak currency then induced inflation into Brazil. The stock market is facing a number of crosswinds, as you can see here: tariffs, stagflation, and the Fed, elevated valuation, innovation, and geopolitics. Let's look into each one of these, beginning with tariffs. As we can see here, tariffs are meaningfully higher, but not as high as threatened. The present tariff rate of about 18% is certainly higher than the 2% level at the beginning of the year, and it is the highest since 1933 amid the Great Depression. Implementation of tariffs will increase receipts to the U.S. Treasury, a revenue stream to the government that may help soften deficits. But it is a revenue stream with many geopolitical ripple effects, and one that in prior centuries has had a bit of an addictive aspect, being comparatively easy to start tariffs, but very difficult to shut down that revenue stream once it starts. Consensus impact to the economy is a modest depression of GDP from baseline levels of about 0.5% each in 2025 and 2026. Consensus for inflation is that tariffs will lift the consumer price index by about 1.7% above the baseline rate. Unemployment will rise about 0.4% above the baseline level. And all of these effects will be transitory over the next 1 to 2 years. The trade policy uncertainty index is settling down a bit, though it is still above levels seen prior to this year. The reduced uncertainty has been a tailwind for the stock market. Stocks, of course, do not do well amid rising uncertainty. We borrowed this slide from the Yale Budget Lab since it seems to isolate which products are likely to see the most elevated levels of inflation and seems to provide a decent visual for the transitory rise that eventually settles back into a less punitive level as product substitution effects work their way through the economy. We would note that the chart focuses on those products that are likely to be impacted most by tariffs. It does not include those products and services that will see little to no tariff-related inflation. So overall inflation will likely be less, perhaps much less than this chart would suggest. The employment picture here does not look especially robust. Recent payroll gains have been quite small, and in June were even negative for a month. Unemployment, which is not shown here, is lifted to 4.3%. Well, that's at a 3-year high. Not really a recessionary level, still a low level, but the employment picture, again, not super robust. Inflation, as measured by the Consumer Price Index, it's way down from its post-COVID high of about 9%. But inflation figures have bounced off of the late spring lows of just over 2% and have crept up to pretty close to 3%. With the prominence of the tariff headlines and related price increases, the Fed is clearly concerned about a possibility of a secondary wave of inflation, a scenario that played out in the late 1970s and early 1980s. At this point, the Consumer Price Index is not really high enough to be a problem, but it will need to be monitored closely by central bankers. This is a chart of the S&P 500 over the last 10 years in blue and the valuation of the S&P 500 using the price-to-earnings ratio in purple. As you can see, the S&P 500 has done well over the last decade, lifting just over 300%. Some of that is due to elevated valuation as shown in purple. The present price-to-earnings ratio, or the PE ratio, is 22.7, which is indeed near the upper end of the 10-year range of about 14 times to about 24 times. The elevated valuation does not mean a correction is imminent, but it does reduce long-term return potential for new investments in the market today. Stock and bond valuations have converged in the last 2 to 3 years. This chart looks at the earnings yield on the S&P 500 compared to the yield on the benchmark 10-year Treasury bond. Whichever line is higher in this chart is the better value. Stock and bond valuations used to trade in close tandem back in the 1980s and 1990s, but after the dot-com bubble burst, bond valuations escalated well above stock valuations. That lasted until the bond bear market of 2022, the worst bond market in over a century, and today bonds and stocks are again on par with each other. The style factor breakdown year-to-date has yielded very few surprises. In the bear market of the first quarter, the market was led by the defensive styles of low volatility, value, and income. And with the bull market in the second quarter and third quarter, the market is now being led by the more aggressive styles like high beta, story stocks, and growth. Also, with the market up 13% year-to-date, this means that the year-to-date returns are also favoring the more aggressive investment styles. The sector breakdown in 2025 so far also favors those sectors that are dominated by more aggressive stocks. Growth-oriented sectors are clearly leading the pack so far, so technology, communications, and discretionaries. In contrast, the more defensive and value-oriented sectors are lagging: energy, healthcare, and staples. The first half of 2025 saw a notable improvement in market breadth, but in the third quarter that market breadth is again narrowing. Recall market breadth in 2023 and 2024 dropped to a 40-year low, as over half the gains were driven by just 7 stocks, the so-called Magnificent Seven. The big driver then was generative artificial intelligence and the rise of ChatGPT and other large language models. Will the back half of 2025 revert to a market with just 7 of the stocks in the S&P 500 outperform and most of the other 493 stocks underperform? Well, that's a real small dartboard for professional investors, and it's an environment that it's difficult to think independently from peers. Our read is that some narrowing of the market is likely, but it's not likely to revisit the record level of concentration seen in 2023 and 2024. This slide has a lot of information to process, so I might direct your eye to the table on the left and see that the U.S. S&P 500 coming in fourth from the bottom of this ranking of stock market performance by country. Most of the U.S. underperformance was isolated to the first quarter amid America's new and isolationist trade policies, combined with some loss of steam coming from the generative AI investment theme that had done so well in the prior 2 years. In the second and third quarters, the U.S. markets rallied, but not really any more than the rally in the non-U.S. markets. Most non-U.S. markets benefited from more dovish central banks, as well as capturing investment outflows from the U.S. markets, especially in the first quarter. Some regions in Latin America and Asia benefited from reversion after being oversold in 2024. A few markets were worse than those in the U.S. Turkey, for example, is at the bottom of the ranking, mainly due to political instability and challenges with the lira. India also remains under pressure, reflecting military tensions with its next-door neighbor Pakistan, as well as uncertainty related to India being a big buyer of Russian oil. While the stock market has bounced since bottoming near the Liberation Day tariff news in April, the US dollar, which also sold off in the first quarter, well, that's not really recovered and it remains near its low. On the left is the US trade-weighted dollar index, which has dropped to about a 3-year low and remains near its 3-year low. On the right is a 3-year chart of the euro exchange rate against the US dollar, and the euro, well, that's at a 3-year high. Note that the euro is actually the biggest component of the US trade-weighted dollar index. While the dollar has hit a 3-year low, the lows are actually just below the lows of the normal longer-term 10-year trading range, so it's not really a headline maker as long as there are not any further declines from here. Same story with the euro hitting a 3-year high. It's possible we could see another leg down with the Fed moving towards a more dovish policy. After all, a more dovish central bank reduces the attractiveness of a currency, a relationship known as interest rate parity. If we have maybe another 10% weakening from here, that would likely be a tailwind for some of the weak dollar sectors like oil and materials, and a headwind for some of the growth-oriented strong dollar sectors like many of the Magnificent Seven technology stocks. But we will cross that bridge if and when we come to it. We'd now like to move on to part 2 of our slideshow today, the economy. We'll begin by looking at some of the tariff-related factors impacting gross domestic product. This is an interesting slide here that shows the sizable swing in gross domestic product before and after the April Liberation Day tariff announcements. At a raw headline, you can see the gross domestic product shrank from 0.5% in the first quarter, but then roared ahead 3.3% in the second quarter. But you can also see that massive swing in the trade deficit as businesses tried to front-run the tariffs by triple and quadruple ordering imports in the first quarter and then freezing import buying in the second quarter. The import swing essentially rendered the gross domestic product figures meaningless in the first quarter and the second quarter. A better way to guess at economic vitality in the U.S. is to really just look at consumption, which is the largest component of gross domestic product and a component that's not really touched by tariff front-running. Consumption is shown in this chart in light blue. Consumption grew 0.3% in the first quarter and 1.1% in the second quarter. Those are weak numbers, but they're not really a recession. In other words, the U.S. economy is basically muddling along here. Two areas of particular strength in the U.S. economy are AI infrastructure spending and healthcare. The first chart in particular seems to capture the data center build-out associated with the growth of large language models. The growth is clearly not slowing. Indeed, in the second quarter, AI infrastructure spending gained 37.9%, a very healthy growth rate. The second chart shows amid the soft payrolls and employment figures, the healthcare sector actually continues to add payrolls. No weakness in the healthcare sector. This table shows the quarterly gross domestic product growth rates over the last few years for most developed countries of size in the world. Latest data is for Q2, and as of Q2, the world economy had really no major weaknesses, but also not really any major strengths. Of course, U.S. tariffs are clearly distorting the GDP figures in the U.S., and also likely distorting figures at some of our closest trading partners like Canada and Mexico. Still, consumption figures are generally modest, but positive, and that's a worldwide phenomenon. Inflation is moderating in most countries, especially when compared to the peak levels in 2022. Some countries are now even below the 2% target rate, including Canada, China, and South Korea. Of course, there's also a few countries going the opposite direction, perhaps signs of that secondary wave of inflation that's happening in Europe, Mexico, and the United Kingdom right now. Tariff policy seems to be a major uncertainty when thinking about future inflation. Will tariffs induce the feared secondary wave of inflation? Or will tariffs and tariff uncertainty induce deflationary economic weakness? Most likely outcome is somewhere in between. The Fed is on record saying modest inflation and slower growth. U.S. housing affordability has been in the news recently. As you can see here, home ownership cost is now at 48% of median income, which is well above the 30% threshold of affordability, and it's at about a 20-plus year high. Politicians are discussing whether to declare this as a national housing emergency. At the root of the housing affordability problem is the fact that house prices keep creeping higher, as you can see on the chart at the left, yet at the same time, mortgages are near at 20-year highs, as you can see on the chart on the right. This is really an unsustainable combination. There really is no simple fix for the housing affordability problem, but from a macro perspective, the simplest fix is to lower the mortgage rates. This aims to address what industry insiders refer to as the lock-in effect. This problem was an outcome of the 2020 and 2021 when mortgage rates dropped to near 2% and homeowners everywhere refinanced at the very low rate. But now with mortgage rates at 6% plus, no one can afford to move to another home since that requires swapping an existing cheap 2% mortgage for a new expensive 6% mortgage. That's just not going to happen. So vast swaths of the nation's housing are no longer eligible to be sold unless mortgage rates drop back to the 2% level. We have a housing shortage. Most developers suggest that affordability would improve with more housing supply, and that the bottleneck to increasing supply is about streamlining that permitting process. We're skeptical such an approach would be a quick panacea, but at the same time think there is room for marginal improvement. There are ripple effects to any approach that aims to aggressively lower housing prices, since that can quickly lead to negative equity. Negative equity at a national level will be a big problem for the banking system, as we saw in 2008 as well as the Great Depression. The affordability problem does not really have a simple fix, though lower rates and streamlined permitting would help. To the extent that price escalation slows or stops, perhaps that would allow wage inflation to eventually catch up, though that may take more than a couple of years. We'd now like to move on to part 3 of the slideshow, shifting from macroeconomics to microeconomics by looking at a handful of industry-specific factors that are shaping overall capital markets. We'd like to highlight 5 industry discussion topics as shown here, which includes a discussion of AI, the oral weight loss drugs, precious metals, platinum in particular, algorithmic trading, and liquid biopsy. We'll start with artificial intelligence. We've asked this question several times over the last year and a half. Are we in an AI bubble? Indeed, this is a topic persistently discussed in the financial media. After all, we have seen sizable gains in generative AI stocks over the last few years, and valuations are elevated, making the stocks vulnerable to correction. And in the last couple months, we've seen signs of softening in some of the higher profile names like Nvidia, Microsoft, AMD, and others. Just a reminder about the media mantra: if it bleeds, it leads. The media knows that fear gets more clicks. So with the modest softening of some of the Gen AI stocks, more concerns seem to be getting more airtime. At the top of the list is a recent MIT study that concluded 95% of organizations get zero return on their AI investments. Further, if that zero return VC funding dries up, then the profitable AI businesses like Nvidia and Microsoft, well, those will slump. The underwhelming release of GPT-5 adds more to these fears, so too does the normal risk of that enormous capital spending binge on data centers, spending that is sure to have variability along the way. And amid the big run-ups in stock prices, many industry insiders are increasingly cautious, including big names like Sam Altman, Ray Dalio, and others. It is normal for any growth industry to have periods where gains are consolidated, and from a seasonal perspective, it would not be unprecedented to have such a consolidation during a normal summer slowdown, a period of market weakness which is usually most pronounced late in the season in August and September. That said, while there is some level of hand-wringing about a weak patch in recent weeks, the AI stocks as a group are really just about performing in line with the overall market. The AIQ ETF is up 5.5% in the third quarter, which is slightly ahead of the S&P and slightly behind the Nasdaq. Media headlines about a slowdown are a bit misplaced. Indeed, the move on Oracle moving into the cloud space to compete with Azure and Amazon Web Services seems to suggest that the expansion continues apace. The build-out may run for years from here. To borrow the phrase from Mark Twain, the rumors of the death of AI, well, those are greatly exaggerated. Let's move on to our second industry topic, the weight loss drugs and the impending orals and other formulations. The obesity and type 2 diabetes market is basically a duopoly at this point, with the market split almost evenly between Novo Nordisk, the maker of Ozempic, and Eli Lilly, the maker of Mounjaro. The picture on the left shows a little bit more detail, with the market split 43.3% for Lilly and 56.7% for Novo Nordisk. 2 years ago, the picture would have been almost entirely blue, with Novo Nordisk's Ozempic just dominating the market. Eli Lilly has done a masterful job entering the diabetes space against an incumbent that's been dominating the diabetes market for decades. That's been good for Lilly shareholders and, well, not so good for Novo Nordisk shareholders. Both Lilly and Novo have multiple brand names for their core active ingredients, as you can see here. Novo's semaglutide goes by 3 different marketing names: Ozempic, Wegovy, and Rybelsus. Lilly's tirzepatide goes by 2 marketing names, Mounjaro and Zepbound. The differing brand names for the same active ingredient mainly reflects the differing target markets, especially obesity versus type 2 diabetes. The massive publicity and success around the new obesity and type 2 diabetes treatments is drawing more competition into the market. This table shows 19 of the higher profile obesity and type 2 diabetes treatments presently in later stage clinical trials that use technology that is similar to Ozempic and Mounjaro, especially with the GLP-1 and GIP technologies. Clearly the field is not static, and the pharmaceutical industry will not stop at just Ozempic and Mounjaro. Most investor R&D focused at present is on the Lilly and Novo pipelines. The headline maker today is Lilly's new oral GLP-1 orforglipron. The upside of an oral medicine compared to an injectable is that the oral is more likely to get used and hence has better medical compliance. The downside is that the orals are less precise than the injectables. Indeed, Novo already has Rybelsus on the market, an oral version of Ozempic, or semaglutide. Clinical data for Rybelsus, well, it's not as compelling as that for Ozempic. We seem to be getting a similar experience with orforglipron, though orforglipron is a new molecular entity, not a reformulation of Mounjaro or tirzepatide. Our read is that orforglipron has the potential to be the best of the orals, but will still pale a bit compared to the injectables. More data is still forthcoming, though. Beyond orforglipron, Lilly's retatrutide and Novo's CagriSema both have compelling phase 2 data that might move the needle in 2026. Outside of the two incumbents, Lilly and Novo, the overall field is getting more entrants, and the two-way duopoly is likely to see more entrants. In particular, Viking, Amgen, and Regeneron seem to be on the cusp of possible launches in the next 1 to 2 years. We've owned Lilly as a core position for most of our history at Cedar River, a name that has been very rewarding. While we're enthused about the pipeline, retatrutide in particular, we're also a tad cautious of the new entrants, so we've been scaling back our position in Lilly. Our long-short strategy, we took a short position in Novo Nordisk about 18 months ago, mainly on concerns about how the launch of Mounjaro would impact Novo's Ozempic. These concerns actually have played out, and Novo stock has actually softened, and we have scaled back our Novo short position. We do retain a small position in AstraZeneca, which has 3 phase 2 obesity treatments which seem intriguing. However, our position in AstraZeneca mainly reflects a broader view of the sizable pipeline, a few drugs going off patent, and a reasonable valuation just below a market multiple. Now I'd like to move on to our third industry topic. I'd like to talk about precious metals and platinum in particular, wondering, well, platinum has sure done well. Is it platinum the next NVIDIA? What is happening with platinum? The precious metal has been trading in a narrow range for about 3 years, and then boom, it exploded about 50% higher in April of this year, and it's been holding steady at the new higher level. What changed? The lift in the price of platinum overlapped strongly with the Liberation Day tariff news. Platinum itself is not subject to tariffs, nor are any of the other 3 precious metals, gold, silver, and palladium. But precious metals are sought after as a monetary alternative and are a draw when the US dollar faces weakness. Crypto has this same feature. Platinum and palladium are 2 of the smallest precious metals. As small cap metals, it does not take much to move them. But after Liberation Day, there was massive stockpiling of platinum, especially in the US and China. At the same time, South Africa, which is the biggest miner of platinum and palladium, well, they've been facing transportation challenges with the rail system. Mine level inventories are actually high, but with rail disruptions, the inventory cannot make it to port. In addition, we have had a situation with many of the pure precious metals rallying. Platinum seems to be the Liberation Day monetary alternative poster child with a year-to-date gain of almost 54%. But all of the monetary alternatives have rallied in 2025 so far. Notably, there are 2 drivers here. The first is the US dollar weakness around the tariffs. That policy change moved even some of the largest central banks in the world to start buying gold, the largest and most liquid of the precious metals. The second driver was the bull market that increased the appetite for risk assets. This is especially the case with crypto. Where are we headed from here? Well, we think most monetary commodities are headed higher, but not all. We're a tad skeptical of the size and speed of the move in platinum and palladium, sensing that the stockpiling in the US and China is a bit overdone, and that South Africa will eventually get that rail system fixed, which will dump more metal on the market at these high prices. In contrast, gold prices seem headed higher as non-US central banks seem unlikely to stop buying with the US dollar weakness and trade policy becoming increasingly repellent. Crypto also seems likely to head higher near term, with more volatility along the way associated with being a risk asset. We'd now like to move on to our fourth industry topic, algorithmic investing. One of the beneficiaries of generative AI is the area of algorithmic investing. Now, to be clear, Cedar River is a fundamentals-based investment firm, and algorithmic trading is, well, it's not really our specialty. But algorithmic trading is in a parallel business to ours, and so we feel a sense of obligation to understand how our cousins are faring amid the changes of Gen AI. Perhaps there is something we can learn. Algorithmic trading is seeing a couple of tailwinds from the advancement of Gen AI. For those who have not looked in recent years, algorithmic trading has advanced well beyond the simple technical chart patterns and momentum of the 1990s. Indeed, one of our more intriguing analytical tools for algos is the sentiment analysis tools that use natural language processing to scan news and gauge sentiment. Of course, traditional tools have also been enhanced with machine learning and automated strategy refinement, and many of these tools have spread beyond large prime brokers and into mass market brokerage platforms. Speaking of platforms, this table is a quick look at the top algo platforms for individual investors. Interactive Brokers and TradeStation remain tied for the largest of the algo platforms for individual investors, but most bulge bracket brokers also offer platforms and APIs. Notably, some algo platforms specialize in a particular asset class like foreign exchange or crypto. This table just looks at the generalist, not at the specialist platforms. Cedar River piloted a handful of algo strategies over the course of this last year. Our thinking here was that there's merit to the idea of combining our fundamentals expertise with another discipline such as technical analysis or algo trading. We've seen this work before at other organizations. As a visual aid, the pic on the left is an excerpt of our simplest algorithm, which ran higher frequency Bollinger Bands and moving average crossovers. We also ran algorithms based on AI-driven sentiment analysis on news flow. Cedar River intends to remain a fundamentals-based investing shop, but we'll keep an open mind on algorithmic trading as technology advances. We were clearly intrigued with the AI-based sentiment functionality and expect more functionality in the future. That said, the algorithm did have drawbacks, top on the list being what we would call the pigeonhole problem, where computational constraints reinforce unnatural approaches. A good example here would be high-frequency algorithms get tested and debugged much faster than slower frequency approaches. End result being you end up never really doing any low-frequency algorithms. That's a pigeonhole problem. It's also easier to react to news that's pre-announced on a particular schedule, so you end up never really doing news that is not really on an identified schedule. That's another unnatural pigeonhole. These drawbacks aside, the algorithm experience today is far ahead of back where it was in 1994, back when Jeff Bezos, the founder of Amazon, was an algorithmic trader at D.E. Shaw. I'd like to move on to our final topic here, another biotech subject. Liquid biopsy goes mainstream. There are two liquid biopsy pure play stocks, Guardant Health and Grail, and both have more than doubled this year. The technology is exciting, being able to detect cancer from a drop of blood rather than a traditional tissue biopsy that is then sent to a histology lab to determine if the biopsy is cancerous. Liquid biopsy promises to be easier for patients and better for public health. This is a major disruptor to the histology laboratory as we've known it. And from the perspective of many adults over the age of 50, the holy grail of liquid biopsy is the potential to supersede and eliminate that dreaded colonoscopy. Liquid biopsy is still a new technology for cancer detection. At present, there are really three dominant players in the market. Grail is the purest play on early cancer detection. Guardant does early cancer detection plus advanced stage cancer detection, and Exact Sciences, well, it's a little broader based and does early and advanced cancer detection as well as non-blood based cancer detection. There are nearly a dozen other companies working on peripheral technologies such as genetic proclivity tests and various circulating relapse tests. Histology industry insiders have been aware for years that the clock was ticking within the histology business. Here's a one-liner from over 10 years ago from Ken Marzinski, CEO of Springside Scientific. Liquid biopsy will transform and disrupt the histology industry. Well said. Like many growth industries, the valuations of liquid biopsy companies run rich, with enterprise to sales multiples running from 3.5 times for Exact Sciences up to over 7.7 times for Guardant Health. And for the two pure plays, Guardant and Grail, profits are not yet there yet, reflecting costly new product introductions. Exact Sciences looks comparatively cheap, but that mainly reflects a non-liquid biopsy business that is mature and slower growing. Relative valuations have been narrowing or widening as clinical data on screening tests is released. 2025 has been a good year for liquid biopsy. The tailwind seems likely to continue, but at a more moderate rate going forward. This is a new market that is hardly tapped, a compelling story for concerned individuals as well as a compelling story for public health. Of course, this is a new technology, and that does come with risks for both the product as well as the rollout. The playing field is not yet firmly established, and bigger pharma and medtech players could easily alter the dynamics quite quickly. 2026 seems unlikely to be as positive as 2025, but tailwinds seem likely to exceed the headwinds. Before we conclude, we have one more slide looking at the stock market over the longer term. The stock market is up 13% year to date, which puts the market on track for a relatively normal year. What is a normal year? Average return over the last 151 years is about 9.8%, with a fairly wide variance. Standard deviation is 16.3%, and the range over that period has been as low as a loss of minus 47% to as high as a gain of 54%. From the picture here, you can see that up years are more common than down years, about twice as common. The conclusion here is that while there is much variance from year to year, the longer-term buy and hold strategy has statistical merit. That concludes our slideshow for today. Thank you so much for listening. Again, please reach out if you have any comments or questions. Our contact information can be found on our website at www.cedarrivercapital.com. We would love to hear from you.